What is going on, guys, and welcome back to season 2 of the 2K Robinhood options trading challenge. In this series, we started a Robinhood account with 2K and we are trying to grow it to 3K as quickly as possible. In season 1, it did not go well at all. We started with a 2K account and basically ended with an account somewhere around $1,500, a little bit less than that even. So obviously not going well, but we have turned around and we are trying a new strategy. So in season 2, we are doing a little bit of something different that we are going to discuss in this video. It's a whole new strategy. It's a little bit longer term. It's something that I am more comfortable with and think we're going to have a lot more success over the long term with. So if you enjoy the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And I'd love to hear your comments down below about what you think of the strategy and what you are trading in terms of options. And if you remember from season 1, we are primarily trading SPY, and the main reason for that is the amount of volume that SPY trades. So they have the most amount of stock volume, but they also have the most amount of options volume, and that just allows us to get into and out of positions in a fairly easy manner. Here we have the new strategy that we are implementing. So the first thing, like we mentioned, we are primarily looking to trade SPY. We do have IWM and QQQ, which IWM I always forget, but I think it's the Russell 2000, and then QQQ is the NASDAQ. So these also have very good volume, but not the same as SPY. And SPY is where we're most comfortable. So we'll primarily trade on there. If we see some discrepancies on IWM or QQQ, then maybe we'll jump into some trades on there. The biggest change that we have seen from season 1 is this days to expiration. So in season 1, we were trading anywhere from 1 to 14 days to expiration. And a lot of that had to do with just putting out weekly videos. You have to trade a lot. And now we're going to kind of take a step back. So we're going to look at potentially putting a video out for the series monthly, and that allows us to trade further DTE, so days to expiration. So we are looking at 30 to 45 days to expiration, and that gives us a lot more time to be able to manage our trades and also go further out of the money. So a lot more comfortable there. We are still sticking with our probability of profit, anywhere from 85 to 95% probability of profit. And what we've seen so far, and we'll see here in a second, is that has allowed us to get anywhere from $8 to $10 in premium. So that is a decent amount of premium, and that also ties into kind of this last point. So we are going to look at closing our options trades at $1, which would obviously make it a winning trade, right? If we sell it for $8 and then we buy it back for $1, we made $7 in profit. Or if we buy it for, or sell it for $10 and then buy it back for $1, we made $9 of profit. Which again, we're comfortable with that amount. Obviously not as lucrative as some other trading strategies, but this is more of a long-term, slow and steady approach. And then we are also going to look at closing our trades at $25. So if the trade goes against us, we want to get out of it at $25. And basically what that allows us to do is we only need to have 3 winning trades for every 1 losing trade to be a profitable trader. So talking about the strategy is one thing, but I wanted to go in and actually show you what putting on a trade looks like. So we can see right now the market is trading around $399, $398.45 to be exact. So what we do is we are looking at this chance of profit column. So what that is telling us right now is that the market is actually predicted to keep moving up. The market's moved up in a very massive way over the last week. We'll take a look at that in the stock chart here in a second. But what we could see is we need to go down quite a ways to start getting to the 85% mark. And again, chance of profit, that's the same as probability of profit. So what we are seeing is we get to the 85 mark somewhere around here. So this is 373. You can also see that you could trade a 50-cent wide, which would be a $50 put credit spread, but I like to trade those $100 wide ones. So we are looking at 373 versus 372, and that gets us to the 85 mark. You can see that I actually have a trade on for this expiration right now at the 370 to 369. So we are going to just mimic that trade that I've already put on. So what you would do is, again, you have the sell and you have the put selected, and that allows you to pop up this probability of profit. If you have buy selected, it'll say to break even. So you need to have the sell selected, and that gives you a chance of profit. You come down here again. So we're looking at the 370 strike here. So we would sell this put, and then we would buy the put slightly further out of the money. What's weird and what you're seeing here is it's actually going to tell us that this trade is worth like 2 cents, 2 or 3 cents, because it's after hours. The pricing is off, but this chart will actually show correctly where the stock price, or where this trade will actually work out to be. So that's what we're going to pay attention to. So again, it shows that we would only actually receive a credit of 2 cents. That's not right. If you trade this during market hours, it'll actually show up correctly, and it'll actually show what you're seeing down here of a max profit of $10. So you would actually collect a credit, assuming the market doesn't trade up or down in a massive way on Monday. You would collect a credit of $10, and then your max loss would be 90 cents or $90. And what you could do with that again is put on a stop loss. Like we're talking about, we don't actually put a stop loss on. We're just monitoring our trades on a daily basis. So we aren't actually going to incur this max loss of $90. We are going to focus on trying to get out of the trade if it goes around that $25 mark. And then also if it goes down to $1, we'll actually close it for a profit. After showing that, I do want to give a disclaimer. One, obviously don't trade anything that I am showing you here. This is just for your knowledge on how to basically trade this strategy. If you're interested in it, do your own research, look into it, see what you're comfortable with. Also, I would not put that trade on for reasons what we're seeing here. So right now we can see the RSI is actually trading up. It's not above the 80 mark, but it is trading up. And then we can also see that these Bollinger Bands, we are actually trading above the Bollinger Band. So I'm actually predicting or thinking that the market will actually pull back a little bit. I hope it doesn't pull back too far. I'm hoping it kind of pulls back to the 385, and then potentially we see another bounce to the upside. But right now we're trading kind of at a premium compared to what we've seen over the last couple of weeks. And it would be nice to kind of see the market actually pull back so I can put on a few additional trades. Right now we're a little bit light on the trades. Again, we'll get into the account here at the end of this video, but let's go ahead and jump into the trades that I've made over the last couple months and go over, see how well this strategy is actually working. Here we have a recap of all of the trades that we have made since the end of season 1. So towards the end of season 1, these are the last few trades that we actually made using the old strategy, again, where we were trading like anywhere from 1 to 14 days to expiration. So obviously we have one loser in there and then one winner. And then we have also traded a few calls and puts against SoFi. Overall, up money there. We do have this Google debit spread that we put on earlier in the challenge that expired worthless. So we lost the full $112 there. That just wasn't a good trade. Google, we thought was going to rebound. It obviously, did not, and has been down in a fairly significant way, which has a big negative impact on the account. But it is what it is at this point. And then we also have this debit spread. So we put this on also earlier in season 1 that we closed for $27. Things kind of bounced to the downside. We saw it as a good opportunity to get out, and that's kind of proven to be the right decision because we got out and we were able to get a little over half of that money back. So overall, good to close that trade. And then the other trade that we've done that really hasn't coincided with the strategy is we saw some earnings with Cracker Barrel, and we were predicting a very significant fall in earnings. And honestly, I was hoping more for just a run up in terms of volatility around the earnings announcement, and we did not get that. We actually lost a lot of volatility. The stock kind of popped up because the market was popping up. So we ended up closing out this trade actually before earnings. That was the plan all along. We kind of stuck to the plan. But then what was sad is after actually Cracker Barrel announced some poor earnings, so the stock actually fell in a fairly significant way, and we would have made, I think it was around $100 to $150 on this trade, but we closed it early and we ended up incurring a $22 loss. So those are the random trades in there, but let's jump into some of these trades that we've actually made with that strategy. So with the new strategy, what I have done is I went through and actually earmarked all of the trades that we have made with that strategy that we just talked about, the 30 to 45 days to expiration. And I've jotted down all the winners and all the losers. We have only actually had one loser. We've made 9 trades in total. We've only had one loser and we've had 8 winners. And we can see from the 8 winners, we've actually profited $65. From the one loser, we lost $21. And this is the one losing trade. So we put it on for the end of December, and basically the market kind of corrected to the downside. If we actually had let this trade play all the way out, it would have closed for a profit and we would have collected the full $8. But we're just sticking with the strategy, and we said we were going to close, around $25 to $30. So we ended up closing. The reason it's at $29 is basically the market dropped in a fairly significant way after hours or, pre-market. And basically when we went to close it, it was at $29. So we ended up taking that loss. And again, when you subtract add $29 and $8 or negative $29 and $8, you end up with that $21 loss. So So that's what we're seeing there. But overall with this strategy, you know, over the last couple months, you can see these trades go back to December. So really only over the last month and a half, you can see that we have actually, you know, had a fairly good profit of $44. And there is one trade, you know, with the market spiking up, we've actually already been able to put on a trade in February and close that trade in February in a very short amount of time. So again, part of this has to do with the strategy working well, but also part of this has to do with the market and how the market is moving. So if the market continues to move up, you know, in a very slow fashion or in a quick fashion, whatever it may be, then this strategy is going to be profitable. But if we see, and even if we see the market move down in a very slow fashion, you know, as long as we move our strikes far enough out of the money, we'll be okay. But if we see the market move down in a very significant way, that's when we start getting hurt with this strategy. Let's close out the video by taking a look at the Robinhood account. So here today, we were up 1%, a little over $15. And if we look at the last 3 months, we can actually go back to around where season 1 ended. We can see season 1, we ended around $1,400. And since then, we've seen basically SoFi have a large effect on the account. So SoFi we'll jump into here in a second, but it moved down in a massive way, and that caused the account to drop, you know, down below $1,400 into the $1,350 range. And really, again, a lot of that has to do with SoFi. So if we come over to SoFi's chart, we can see around, again, a similar time we saw SoFi spike up, which is that little spike we saw around the middle of November. And then we can see that SoFi dropped in a fairly significant way. And a lot of these, you know, lows coincide with lows in the account. Again, just because SoFi is the one holding that we have in the portfolio. But right now it's about back to break even. Our cost on our SoFi shares, we only have 100 shares. It is around $5.50. So we are going to be looking at hopefully selling call options against this position here again. And over the last week, with kind of a positive move up in SoFi and, you know, a positive move up overall in the market, we are actually up almost 7%. So around $100, which is a huge move. And again, you know, over the last month, we are still actually up. So over the last month, this is primarily where we're starting to see, you know, a lot of those options trades going our way and, you know, moving in a positive direction. So really overall right now, another thing to note is we only have one put spread on. So we are looking to add, you know, around 2 more. What I've been focused on is trying to keep around 3 trades on, put credit spreads on all the time. But with the market moving up over the last week, again, we haven't really had the opportunity to. So we did put this trade on, you know, sometime in the middle of the week, just so that we have a hedge. If the market does keep moving up, then, you know, we'll still be able to profit. But we're kind of thinking that the market will move down sometime next week as we're kind of trading at around those highs for the Bollinger Bands that we took a look at earlier. So if it does, that will present us with an opportunity to put on 2 trades. And hopefully, again, the market doesn't move down into too significant of a manner, because we don't want it to move, you know, and start pushing up against this 370 and 369 strike price. Only other thing on there is this Google trade. So this is that debit spread that we put on a long time ago. Right now it's at $93. We want to see, we're going to let that one play out basically all the way through. You know, if it gets up to maybe around 120 where we put the trade on, maybe I'll take it off. But I honestly think Google is going to be above $100, probably above $102.50 by the expiration date that we have here of June. So I think the market's going to, you know, start correcting in a fairly significant way as we start seeing interest rates level off potentially and inflation start dropping. So overall, again, a lot of my opinions are presented in this video. So don't take anything as financial advice. Make your own decisions. Look at these options trades, and options have a lot of risk. So always consider that. Start with a small account and work your way up to, you know, something bigger. If you have $500, you know, you could throw it in an account and maybe, you know, put on a couple of these trades and see if you're comfortable with it, you know, and if you're not, you know, take a step back, learn a little bit more, and then maybe dip your toes back in again. So overall, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.